Compound Nation. Stock market went up today. I don't know if anybody noticed. I was beginning to think that sort of thing was impossible. But here we are, plus 640 green on the Dow. NASDAQ held most of the gain today. Wasn't the worst. Nice to see, even if it doesn't last. Listen up. Quick item of housekeeping, and then we'll say hello to some people. If you have not yet subscribed to the Compound channel on YouTube, what are you waiting for? We need you to subscribe. Click. Is that clickable? Duncan, can I point to it?
No, that's not clickable.
Work. Oh, all right. Make it clickable next week. Subscribe to the channel and tell your friends about us. The other thing that I wanted to mention, we love answering your questions or viewer topics. We do a couple at the end of every show. You guys are giving us great food for thought. So if you have not emailed us, or you haven't in a while, ask the Compound Show at gmail.com. Keep your amazing questions and topic suggestions coming. We love to go through the mailbag, and it gives us really good ideas of what you guys want to hear from us. So don't be shy. Duncan reads everything that comes in. So don't be shy, and also don't be racist. All right. I wanted to say hello to a couple of people real quick. Let's say hello to Kenny Dwyer. What's up, fellas? Love the show. We love you, too.
Thanks,
Jay Luther,
Kenny.
Eric Barrows, Dr. Horton is back. Thomas Carba is here. Jerry Kachoyan, his first time here live.
Oh,
Jerry, we miss you, Jerry. Ben Phillips is in the house. A lot of great Joe Ochapinti. I think I'm saying that right. Manesh is here. JJ's here. Nolan Abell. Terrence Ree. What's happening, my friend? Jack Rosenfield. Stay long energy.
It's 5:30. It's 5:32. Let's get
to enough.
Shall we?
All right. Guys, welcome to the show. Sponsored tonight by Y Charts. We love Y Charts. Greatest sponsor in the world. Michael, say a few things about Y Charts.
You know, what can I say about Y Charts? I'm
going there.
I'm on the chart off. I'm on the service all day long.
Yeah, you are.
Literally all day long. Economic data, stock market data, you name it, I'm on it.
True that.
For example, I'm looking at my dashboard right now, and I'm seeing green everywhere. You know what was on the bottom of my performing list today? We're going to get to this later.
What?
Home builders.
Totally unsurprised by that.
Up 40 basis points today.
That's
Energy
exactly...
up 4, semis up 3, discretionary up 2.6, home builders.
Talk to 2 or 3 people who work in residential real estate, and you will understand why that's totally expected.
You act like you've got like a stable of these people.
I really do, though. I really do. I talked to one of the biggest mortgage originators in South Florida on Friday. He's like, dude, it's like somebody flipped a switch. We'll talk about that later.
Yeah, Jerome Powell. We know.
Yeah,
we know who flipped the switch. All right, let's get right to it. We're gonna start off talking about the down 80% club. Not a club you want to be in. And you know this whole JC Peretz thing. The market peaked in February 2021. I think I finally know what he meant, because the market objectively did not peak in 2021. The market of nonsense, investor enthusiasm, peaked in 2021. That's a fact. So I was looking at a chart. What I did was I looked at all of the...
Wait. He said if it's a market of stocks, most stocks had their peak already.
That's not true.
In February 21.
That's
not true?
No, empirically false.
Okay. All right. Go ahead.
Okay. So what I did yesterday was I was looking at stocks that were down 80%. And I was like tracking their market cap.
So my portfolio.
Everyone's portfolio. Those stocks peaked in 2021 of February. So let's throw this up. This actually surprised the hell out of me, because when you think about stocks that are down 80%, you think of most of the small names. They're not all that small. So over $1 trillion has been wiped out. These stocks, again, these are Russell 3000 stocks, which, by the way, I learned going through this exercise. Chart off, please, although it's a beautiful chart. Robinhood, Coinbase, not in the Russell 3000. Make it
really?
What, yeah.
What are they in? Are they in the Wilshire 5000?
I guess so. Anyway, so this surprised me. $1 trillion in market cap wiped out. It didn't go into Apple, Josh. It just got wiped out.
So it had to go somewhere, though. It went into money market fund. It went to cash. It had to.
Stop.
What? It can't just disappear into thin air. Come on.
I know you're shticking.
I understand it got wiped out of the stock market, but it didn't disappear like it never existed.
Oh,
it's still
that's
dollars sitting somewhere.
No, that's pretty much what happens. All right, let's look at some of the bigger ones though on this list. Look at this max market cap of these names. So Rivian, for example, had a max market cap of $153 billion. It's down $23 billion today. Josh, if you look at this, if you look at this list, what has a shot of coming back? Because
wait, we're not on the list. John, jump us to the list. There it is. So this is the companies with the biggest decline. These are the 80% down club, and how many dollars they lost.
So there's a lot more of these, but these are all of like the name brands, you know,
the ones we all know.
The ones we all know. So for example, Zillow went from 49 billion to 7. I don't know that it's getting back to $49 billion. I guess it has a shot, but like Robinhood is at 6, down from 60. That seems to never be getting back to 60.
Can we just pause on this Rivian number? That is absolutely breathtaking. Square 2, I guess. But Rivian was when was it 153 billion?
Right at the IPO.
That is fucking crazy. Oh my God. Wow. Okay. So, all right. So it's unlikely that more than, I'm making up a number, but just hear me out. It's unlikely that more than 20% of these names will ever approach those old highs again.
Way less.
Maybe it's unlikely, way less. Right. And if you go back and study past blown up bubbles, something I said, if you go back and study past blown up bubbles, you will very rarely find companies that make the transition into the next bull market and stay relevant. Most of the time, they remain in decline forever. So what are like 1 or 2 names on this list that you think could buck that trend?
Throw that back up, please.
I would say...
Josh, look at Ring Central. Ring Central is worth $40 billion. How in the world? We use that software. I mean, it's okay. It's okay.
It's just okay. Rocket companies, that's mortgages?
Yep.
Holy shit. I don't know, man. I don't know which of these will be relevant in the next bull market. It's really... I'm tempted to say Penn and or DraftKings.
I'll throw out Beyond Meat. I don't know. Why not? Here's the thing. These companies, like, they're going to look
Coinbase. I would guess Coinbase is still relevant.
If they ever take out their max market cap, they're going to be different. They're going to be different businesses, right? They're going to pivot into something that we don't see today.
Oh, you got that right, Jerry. Yeah, none of these in their current format have a big enough business fundamentally to ever have justified what those market caps were. I think
Coinbase is a decent call.
Or Square. I don't. What would make Square worth 129 billion? Like, what percentage of their market of the market share of their industry would they have to capture for anybody to pay that much for the company again? I don't know. Very, very tough, man.
So I threw this up yesterday. Peloton, 1 point.
Well, that's
last year.
Pony. Yeah.
Peloton was worth more than MetLife.
Was it?
Peloton in January 2021 had a higher market cap than MetLife.
And fundamentally, like, MetLife is like just an absolute cash cow.
So MetLife was founded in 1868. It did $65 billion in revenue in the past 12 months. Peloton did 3.8.
Oh my God.
We lost our minds.
We had Eric Jackson on the show talking about this Carvana. So this was $31.2 billion down to $2.5 billion.
That'll never see $31 billion ever again.
I mean, the balance sheet, the debt, like, there's a lot of reasons why, even if the company becomes on fire and captures a meaningful amount of market share, it's just hard to picture people paying that valuation ever again.
You know what could do it? Open Door. If they ever figure that out, if like the iBuying thing really like takes off, that, I mean, maybe that has a shot. Why was Vimeo worth $9 billion?
I don't even know what that is, fam. What Vimeo is like bootleg YouTube?
It's like the video embed player. I don't know if you go there for videos or Duncan. What the hell is Vimeo? See?
He doesn't know.
Do you really want to know?
Yeah.
Vimeo, it's the more professionalized version of YouTube. People use it for embeds on their websites.
Are you saying we're unprofessional right now?
No. I'm saying it's more like used by like businesses and that kind of thing to embed videos, not so much for people doing live streams.
Okay, so that was worth $8.5 billion. Now it's down to 1.
I was gonna say I'll take the under on that. Getting back to unless
How about this
somebody
Bed and
acquires
Bath?
it.
Bed and Bath was 6.4, which I don't know. I guess you could make I don't know, but right now it's 530 million.
Have you been in one of those stores lately?
Not in a long time. Anyway.
Yeah, it's bizarre. A Bed Bath.
So down 80. If you're down 80, you got to climb 400% to get back to even. And I don't know, 95% of these names will never do that. You can still make money, but if you held from the top, you're probably never going to get back to even.
Well, that's the thing. So as we've said on this show before, and as a lot of people who are much smarter than us have said, like, forget about the old high. That's no longer a useful reference to anchor to mentally or emotionally. It's just not what's going to happen. I want to take a second to address some concerns in the comment section about what's going on with my hair. Guys, I'm in a little bit of a transition period. It's going from very short to like medium long, and there's not like a whole lot that I can constructively do with it right now. You're just going to have to bear with me.
Did Shari do that for you?
No, I promise there's improvement. Well, it doesn't go when it's humid out. It doesn't stay down. It like comes back up. It's a whole thing. I don't want to wear a baseball hat tonight. Okay, let's all give me a little bit of cut me a little slack. We're gonna talk
Can I just say one last thing on the hair thing? Not yours. Don't be
jealous.
I miss mousse.
You did.
Like growing up, I was a gel guy, but once in a while, I would mix it up, throw in some mousse.
I don't think that's for sale anymore. That's how long you haven't had hair. I don't really think that's. It's gel or cream or wax.
What is mousse? Mousse was shaving cream for your hair.
Yeah.
Right.
Yeah. I don't think that's been on the shelves for quite some time.
That went to zero when I lost my hair.
That's right. We're talking about the economy. Michael Hartnett did this thing about how Fed tightening cycles always end up breaking something. John, let's put this chart up. So I thought this was really interesting. It's a good visualization. And basically, you can see the blue line is the U.S. Fed funds target rate. So that's the short end that the Fed has control over. And you see that a lot of these blow-ups throughout history have coincided with spikes or at least rises in that Fed funds target rate. I think this speaks to human nature. When rates are on the way down, people are always taking more risk than they should, and that excess risk doesn't become apparent until all of a sudden rates go higher, money gets tighter, people get a little bit more conservative, and all of a sudden cash is getting sucked out of some place that was relying on it to keep coming in. So like put that back up real quick.
Wait, bank loans blew up? I don't remember that in 2018.
I think those floating rate loan.
Yeah.
I think there was a floating rate ETF.
No, okay. All right.
I think the ETF was representing the asset class, but I guess floating rate loans where all of a sudden there was a big overnight adjustment and some of those loans went bad. I'm not 100% sure. But just like the ones that I've personally seen, like that I can remember, probably starts for me in 1998. But this has been going on for a long time. It's not new. And so the idea that something is going to break due to this particular, or you can take it off, due to this particular cycle that we're in, for me, it's very obvious because of the speed with which everything changed and how quickly the Fed is now moving to play catch up.
Which part is obvious? Something is going to break?
I mean, maybe we were already seeing it. I know we're going to talk about crypto later, which is obviously highly reliant on cheap money and leverage. Maybe that's the thing, and that's not so terrible. But I know a lot of people.
Can you throw that chart back on? Like, look at the levels from which stuff broke, and look at how low we still are.
Yeah, that's my point. So something always breaks. Let me quote from this. So this is Hartnett via, I guess, MarketWatch picked it up. He's the global investment strategy, chief investment strategist at B of A. The average peak to trough bear market decline is 37.3%, and it usually spans 289 days. Matching that pattern for this bear market would put the end of the pain October 19th, 2022, which happens to mark the 35th anniversary of Black Monday, we refer to the stock market crash of 87. Again, that's just a statistical average, but that would have the S&P 500 bottoming it out at about 3,000, which would still be from today's levels fairly painful, but we've done a lot of the work toward getting there still. So his point is at 3,600, we're at 3,600 now. You can nibble. At 3,300, you want to take a bite, and at 3,000, you want to gorge yourself on stocks. And I think that's about right.
Because everyone's going to be greedy. Everyone's going to be greedy when everyone else is freaking out. That's what normally happens.
No, it won't be. But that's what he's telling you to do.
Yeah.
He's saying if and when we get to 3,000, it'll probably be because something broke, something blew up, and I would not argue with that take.
What you're not hearing about yet is like dollar denominated debt having trouble, which that might be the case, like for EM countries. All right, so this chart is from Ramp Capital, also via Y charts. Look how crazy this is. So you've got the purple line, which is the Fed funds rate, which is the line that we were just looking at with the red circles, shit blowing up. And you've got inflation. And look how far behind we still are. Now, hopefully that orange line comes in a little bit. But even still, look how much ahead inflation is over the Fed funds rate. Chart off, please.
I don't know what's going to move that orange line lower other than just comps. Like crude oil fell from 120 to 110.
Yeah.
That doesn't really give you much breathe. It knocks the oil stocks down, but it doesn't really do much in the actual economy. I'm still filling my truck up at $100 plus, even with crude having come down in the last week. And that's not an insignificant amount, 120 to 110, but at the pump, it's just not going to translate yet. And I don't think a tax holiday is going to do anything. I wanted to go to this. The New York Fed keeps its own statistical model, and based on their models, they're saying 90% chance of recession. So this is we got this from Bloomberg, and the only thing I could think of when I saw this headline is, so you're telling me there's a chance? That's higher than what Wall Street is saying. Most of the guys on Wall Street are saying 30 to 40% chance of recession.
Well, that's because that's what they always say. Literally.
Yeah.
Always.
So here, quote, according to the model, the probability of a soft landing defined as 4-quarter GDP growth staying positive over the next 10 quarters is only about 10%. The Economist wrote in a blog post published Friday on the bank's website. Conversely, the chances of a hard landing, defined to include at least 1 quarter in the next 10 in which 4-quarter GDP growth dips below negative 1%, as occurred during the 1990 recession, are about 80%. So they're pretty much telling us the die is cast. And I think just hearing the Fed speak more openly and use the term recession like it's going to be a possibility, maybe we're getting closer to where we need to mentally.
Hopefully, we've said this, hopefully it's just a financial recession where it's more pain inflicted on Wall Street than Main Street. And you saw that in asset prices. This chart we threw up last week from Bespoke showing the dollar declines.
Yeah.
What was it? 15? I can't remember. It's 10 trillion. It's a ton of money has already been wiped out. Now, can the real economy withstand this? I don't know. Probably not, but we'll see.
Right. Okay. I wanted to do this intermarket analysis thing. This comes from JC also. And JC is very heavily pounding the table on this idea that the dollar is extremely important to watch right now and is behind a lot of things happening between different markets. But we're going to look at the copper-gold ratio. So, John, throw this first chart up. This is JC at All Star Charts, friend of the show, friend of the network. What he's basically saying is that this indicates a shift in sentiment from high prospects of economic growth, where you would see copper expanding and gold contracting, to a more risk-off behavior, which means there's more demand for gold in a risk-off environment. So on the top is copper versus gold. That's in blue. And then in black is just straight-up copper futures. And he's pointing to this potential breakdown, which we're seeing in more commodities than just copper, by the way. Let's go to that. Yeah. All right. And this is just copper futures, and you can see that support line going back to, I guess, the middle of 2020, which has been tested multiple times. This particular test in copper seems to be the most forceful to the downside, and that whole channel could be out of the picture if we meaningfully break below and stay there. Put this last chart up.
By the way, hold on, just stick with that for 1 second. Go back. This is the type of technical analysis that I think is very commonsensical. Not bullshit. You clearly had buyers come in at this level. Why? Who cares? Doesn't matter. They did repeatedly. And when the support, that's like when the dam breaks. And so when it breaks, it breaks.
I'm with you on that. Now, when you zoom out, take a look at where these breakdowns are taking place. JC says at exactly where they broke down the last time we were up here. Look. So this chart is going back more than 20 years, but look at this peak in 09. That was really your signal when the commodities followed stocks lower. That was really your signal that this economy was going to stay sick for a while, and it did. And you really didn't get this resurgence in copper prices until really into 2020 with all the stimulus that took place.
We basically stopped talking about copper for a decade. Remember, is Dr. Copper sick? It was on like a million covers. Didn't matter.
Because it wasn't helpful. It was very noisy. But I think something to watch, gold has not really been a superstar as far as like an asset, as far as like a hedge of any kind or whatever. But copper versus gold, is the economy perceived to be improving or deteriorating? I think there's like some rhyme or reason to that pair.
I think so. What's Yardene's take?
Yeah, so one more thing on this. Yardeni has commodity prices peaking here. So coinciding with what JC is seeing in the charts, Ed is thinking about conceptually. And he's basically saying in the commodity pits, traders often say the best cure for high commodity prices is high commodity prices. That's because when a commodity price soars, it depresses demand for the commodity and stimulates the supply of it. So a higher price, less people want to use it, and a lot more people are going to go out and produce more of it. So that's
just take a second and appreciate the boom bust nature of commodities. Like, look at this chart.
And this is the whole commodity index balanced out to a scale of 100 from 1970. So they don't trend. They boom and bust. This is Ed. History shows that an even better cure for high commodity prices is a recession. So he's saying the charts suggest that the tightening of monetary policy so far this year is starting to slow economic growth, resulting in peaking commodity prices, which suggest peaking inflation. So as ordained by what the Fed is telling us they're going to do, they're willing to risk recession to knock the prices in this economy down, commodity prices being a big component of that. And, I don't think anybody should be shocked at this stage in the game if this commodity roller coaster that they hopped on in the last 2 months stops working. Like right now, a lot of money seems to want to rush into that trade. You could be at the peak of that trade right now for all we know. Historically, recession does the trick. What do you think about that?
Yeah. I think you're I mean, you said a lot. You said it well. I got nothing to add.
All right. Let's throw this last one up on the economy. One to watch. Junk bonds, high yield bonds. This is JNK and HYG, effectively the same thing. Two different ETFs that capture the high income corporate bond market. This looks really, really bad. Like for many reasons, this does not look great for where we're at in the economy. What do you think?
I would just say that these are pretty noisy. They've had prior episodes like this. In fact, multiple. I remember very, very well Carl Icahn, who I admire and respect, and I'm a fan of his, was on CNBC in 2015 talking about like these are like a powder keg. Remember that?
I don't mean the ETFs. I'm talking about the actual bonds. I'm not worried about the ETFs.
No. Okay, yeah. I'm sorry. So am I. I'm talking about the underlying. I don't know. These are noisy. I don't know that. Listen, everything's bad. So yeah, I'm not surprised that junk bonds, the ones that are most highly leveraged to the economy, are under pressure as well.
Yeah. So I think a lot of these charts that we just put up are all saying the same
Everything
thing.
looks good.
Not a lot. A lot of inverse charts look pretty good. Okay. What are we doing next? This is
let's talk about the coming real estate slowdown. And I say coming because it hasn't really slowed yet. We're seeing some signs. So follow Mike Simonson. It's at Mike Simonson on Twitter. He does great work on the housing market. We're basically going to go through a bunch of the charts that he put up yesterday. All right, first chart. The median price of a single family home is still going up. $454,000. That's up a tiny bit. The red line is median home price. The pink one is the median price of the new listings. We're just going to run through a couple of lists. Next one, please. This is interesting. We're looking at the percent of properties with price reductions. And even though we're not historically high, we're at 27%, whereas back in 2019 and 18, obviously this is very cyclical or very seasonal.
Oh, the maroon line is this year, 2022.
Yeah, but so this follows a seasonal pattern. But my point is, look at the slope.
It's inflecting.
Yeah, it's much higher than it was. All right, last year, sales as a percent of new listings, it was basically like it peaked at, I don't know, almost 35% of houses that listed went into contract immediately. Right? It was like open house on Tuesday, best and final by Thursday type of deal. And this is at the lowest levels that's been at in
Wait, I don't understand. Immediate sales as a percent of new listings, meaning like it gets sold the first week or the first day?
Yeah, I don't know what immediate is, but let's call it a week, 2 weeks.
All right, so what was going on in the spring of 22 or the winter of 22 was absurd. Like every house gets listed and gets bought immediately is probably not. I mean, it's great if you're a seller. It's not a great real estate market. Nobody should interpret it that way. So it looks like normal is somewhere in between where we were during early COVID and where we were during late COVID.
So we're transitioning from an unhealthy housing market to an even more unhealthy housing market because last year people could afford the mortgage, but not the down payment, right? Because the median price was just through the roof. Now you can't afford either. It's complete. So maybe this is an area that breaks or that's going to be put on ice. Let's look at the next chart. This is an interesting one. We're looking at the re-list. So basically you list your house, you take it off the market for whatever reason, usually not a good reason, and then you put it back on the market. And I wouldn't be surprised to see this number go significantly higher.
What homes that the seller gave up and then came back to relist it?
Yes.
Why does somebody take it off the market and relist?
Because you want it to be like fresh, I guess. You want it to be at the top of Zillow. Where if you've been on the market for 100 days, it gets stale, right? So you'll take it off.
Brokers will tell you like, all right, let's give it a rest and then we'll come back and it'll be a new listing.
Right.
Even though you can still see that it had been listed prior, it feels new.
So this data set is super noisy, but we saw that housing starts are down 14% month over month. Ben and I were talking about this on Animal Spirits today. We might have seen the peak of the cycle in home starts.
That's not good because we're still underhoused.
Len Kiefer did some great work also on real estate. Look at this. So this chart goes back to 1979. We're looking at 1971. I'm sorry. And we're looking at year-to-date increase.
Holy shit. Look at this.
In the 30-year fixed mortgage. And obviously, 2022 is off the charts. So we are up almost 3%. So I guess the year started, call it 3%. Now we're at 6%. And what has this done to monthly payments? Next chart, please. I mean, this next chart it's absolutely backbreaking. So you talk about something breaking. I don't necessarily know that prices come crashing down. Maybe there's sort of like a strike where buyers and sellers both say, like, I'm out, you know?
Yeah. Monthly mortgage payment based on median existing home price, including a 20% down payment.
Look where we were a year ago. I mean, it was high. It was high, but this recent surge in mortgage rates has basically made it game over if you were looking. Just made it completely unaffordable. And, of course, we spoke a second ago about housing stocks getting killed. Lennar, Pulte, all the home builders, but it's Home Depot, too. All these names. Look at the chart of this home builder drawdown. We're almost, not quite, but approaching 2020 drawdown levels.
So we have inventory. So we have inventories rising in the housing market, which were at an absurdly low level. But I think it's rising faster than people thought it would off of that low. And I guess if you didn't sell, what were you waiting for? Because now it just gets more challenging, and you are not getting the price you thought you were getting a year ago.
If you're selling, unless it's your primary residence, on the other side you're buying, and the calculus or the arithmetic is a lot different today than it was.
Yeah, you're buying with a much more expensive mortgage.
Imagine if you refinance. So this is the home builder chart we're talking about. Imagine if you refinanced last year, which basically everybody did, and you were at a 3% mortgage, a 4% mortgage, and all of a sudden you're getting out and you're going up to 6 point whatever. Who's doing that?
Can we go back to that home builder chart drawdown? So we are now rivaling literally the COVID-19 sell-off in the home builders. I mean, this is unbelievable. So this is the thing with investing in stocks in the stock market is that, like, obviously they all sold a ton of homes, right, in the last couple of years. But as a shareholder, you don't get credit for what happened last year. Like, you're buying on the prospects of you have to live through what the prospects are going forward. You don't get credit for anything that happened in the past. So these companies are still, no matter what, extremely cyclical, and their stocks reflect that.
Most of the time, over long stretches of time, the fundamentals drive the market, whether it's stocks, bonds, currencies, commodities, whatever. But sometimes the market drives fundamentals. So Lennar, the co-CEO and president, was talking today on the earnings call, and Joe Weisenthal flagged this. They were talking about how stock market corrections are which have a direct impact on employee compensation plans are impacting like the Seattle, Washington area. And one area, so I do think that there's still so much more demand than there is supply. People my age still are going to buy houses. So even if prices come in, I don't think you're going to see like a 30% crash in the housing market. I guess it's possible. It happened before, but I would think that's unlikely. But where you can see some areas of steep declines are people like tech employees that were moving to Montana because they could be remote or whatever, right? If we have a recession and they get called back and they want to list their house, they're not selling for 2021 prices. No freaking way.
No.
Those might see big haircuts, like big ones.
Right. Like if they bought something in like Sun Valley or like somewhere like really beautiful but remote, it's unlikely that there's like going to be this long line of buyers because everybody's in the same situation.
So they could see a 50% haircut legitimately on prices on homes like that, where it was up 60% year over year, right? All that pandemic inflated housing property from, I don't want to say speculative homes, but you know what I mean? Remote work homes, like those could easily get torched.
I cannot be talked out of the stock market being extremely important for homes north of $750,000. Like I just intuitively know that people are buying houses based on how rich they feel they are and how rich they think they're about to get. I know that's
you're
how
right.
it works.
Especially homes over, I don't know, 3 million, 5 million, whatever the number is, like the upper end of the market.
Yeah.
That's all market money.
Absolutely. So we got median existing home sale price data today, shot above 400,000 in May, which is a record, but the housing market is clearly stalling. So sales of previously owned homes are now down 4 straight months, and they declined 3.4% in May from April, which is like a really steep drop-off in 1 month. But everything that's going on is very steep. So that's a seasonally adjusted annual rate of 5.4 million, which would be the weakest rate since June 2020. May sales are down 8.6% from May of 2021. So the decline is coming in very rapidly, and the National Association of Realtors chief economist said the impact of higher mortgage rates have not been fully reflected in the data yet. So he anticipates more decline in home sales. I think that's like very intuitive and very obvious.
Yeah, I think so.
This is not going to stop on a dime. It's just not.
Wait. I think it is going to.
Really? You think it's going to stop on a dime?
I think
the decline.
Oh, I'm sorry. I thought you meant the price peak. No. Okay.
No. I think this kind of thing feeds on itself, and it probably runs into year end, no matter what the Fed does or the economy does or anything like that. I don't think the housing market can change directions that easily at this point.
I guess my only point is this: like, the reason why I don't see prices pulling back too much, and this is just a guess, obviously, is like people don't panic sell their house, right? If you were going to sell your house and you were in like the market to downgrade to whatever, you did it, right?
You did it already.
And so I think it's just going to be it's going to be less houses on the market, maybe putting a floor in their prices, paradoxically.
Yeah, no, paradoxically, because you know what changes? If you can't afford, if you're in a certain house and you were about to trade up, and now the mortgage rate makes it so not that you can't, but like, wait, 3 to 6% I'm not doing
you just
that.
Wait. You wait.
So then you just stay in your house, which is one less house on the market.
Exactly.
So I think that's a really good point, and that's what makes it very different than the stock market or any other asset market. You can't live in a stock. You can buy something at a high, want to sell it, not have a chance to sell it, and just say, okay, I still live here.
Nobody panic sells their primary residence
yet. I think this is crypto. This is crypto's 1929 moment. Maybe it's over. I don't know.
It's crossed
you know better than me.
With the little dash of 2008.
But it feels that way, right? Is that an overstatement or I don't know?
It might be an understatement.
An understatement. Worst. What's worse than 1929?
Dude, but I'm saying
Spanish flu.
I'm saying the crypto ecosystem is on fire right now. But I don't know if it's Great Depression. I don't think it's Great Depression. The Great Depression, the market lost 90% and everybody was wiped out everywhere. We're not there yet. I'm not saying we're going to be, but the Great Depression was worse than this.
Bitcoin at its low point, down 70% from November.
Okay, so what?
Close.
I'm not saying so what, but it's not down 90. It's a big difference.
So what? So 1 million layoffs. That's so what?
Dude, the difference between down 70 and down 90 is another 2/3 down. It's a big difference.
Yes. However, I honestly believe that a lot of money that has been invested in this ecosystem, not just in coins, but in startups, building things for this ecosystem, is vaporized and never coming back. And you won't even know the extent of it.
That money
because ain't nobody reporting on it, self-reporting on it.
So that money gets vaporized, but this money goes into money markets. Stock market money goes into money markets. This money gets vaporized.
No, vaporized from the crypto environment back into, you know what? I've had enough fun. I'm back in money markets. That's what.
Anyway,
I think.
There's no doubt. It's bad.
Yeah. A lot of people are saying this is healthy. What are they smoking? Why are they saying that? They know goddamn well it's not healthy.
Can you say maybe we're semantics? It's who is it healthy for? It's necessary.
It's not healthy for Matt Damon.
It's necessary to purge all of the excess. They're saying it's healthy. I would say it's necessary. We're splitting hairs.
Can I ask you a question? Isn't the whole point of this whole asset class excess? Is anyone in this for any other reason other than excess? Isn't that the whole point? Is look how much isn't it all about how much money I make and how rich I am and how much smarter I am than everyone else? I was having this conversation with somebody. He pointed something out. I don't know if I fully agree with this. And he goes, listen, I have some crypto. A lot of my friends are in crypto. I'm not saying everybody that's like influential and big in crypto is an asshole. I'm just saying every asshole I know is big in crypto. What do you think about that? Sort of, kind of. Like another, he's like every smug, obnoxious, know-it-all. Like every jerk I know is huge into crypto. I don't know if I fully agree with that sentiment, but I think that's probably more pronounced because of people that are extremely online.
Has there been a resolution with Celsius yet? I know they locked.
Yeah, the Fed bailed them out, and
no, seriously,
J.P. Morgan has agreed to acquire. I don't know.
I haven't seen any news. So they've got 1.7 million accounts. It's a lot. 1.7 million accounts.
I'm not even convinced that that's a real thing that even exists. I'm pretty sure people just invented it and they all agreed that they've heard of it, but there's no such thing. There's no such place as this.
So maybe we're seeing the sentiment, the peak bearish sentiment behind us, because today we got some news that Sam Bankman-Fried is pulling a Warren Buffett, coming to the rescue of BlockFi, providing a $250 million line of credit to them. John Paul Koenig covers Tether pretty closely, and there's been $6 billion of Tether taken out of the market, which is good. It did not. There was not a run
Can you explain how does that work? That's like people redeeming Tether for dollars,
and it didn't break. It did a break. So he tweeted.
So it's functioning.
It's functioning. So he by the way, So he tweeted the quantity of Tether units in circulation fell below $67 billion this afternoon, with Bitcoin stabilizing and the price of Tether rising above $999 on FTX and Kraken. My guess is that redemptions are likely to slow. So, okay, that's good. A little bit of stability in the market, a little bit of panic selling behind us. What's interesting is that the number of addresses that hold more than one Bitcoin, which are small-ish. It's not the whales. Obviously holding, $20,000 worth of Bitcoin is not nothing, but that number is at an all-time high and not even close to slowing down. So this is not
really interesting. That's obviously you would expect the opposite.
You would expect the opposite. But the point is, this is hardly retail panic. It's actually the exact opposite. This is institutional deleveraging. And so, yeah, listen, on Saturday morning when Bitcoin was at 18,000, I don't know if it got below there was no telling where it was going to stop going down. Why couldn't it have gone to 11? Who the hell knows? But we are seeing some signs of stabilization. So
I haven't spoken to a single retail person who said that they will sell even 1 cent worth of their crypto. And a lot of that is they're like, well, I just look at it like it's lost money. So if it ever comes back, it'll be fine. But still, most of this seems to have stemmed from like institutional or hedge fund leverage, people that are like forced to sell. You're not here. Maybe I'm disconnected.
It's not retail panic. It's really
right. I'm not. I think they are panicking, but they're not driving the sell-off. The sell-off's being driven by big money.
I was in Austin this weekend anecdotally, and I spoke to 3 or 4 people there, and they all said the same thing. They're like, yeah, listen, I don't really care about the price decline. This is not like my rent money. This is, I believe in Bitcoin long term and I'm buying.
Yeah, so I heard a lot about that from like civilian people. Like I was out at dinner Friday night with 2 other couples. Both of the husbands are like, they don't know anything about the markets. They have some crypto and they're like, I don't care if Bitcoin goes to 1,000. I'm not selling it. I didn't sell it. I didn't sell it at 50,000. Why would I sell it at 20,000?
That's my mentality. I bought some more on Saturday.
Did you really? Look at you.
I did. 17
and change.
No, I didn't get the bottom. But my point is, I'm with that person. I didn't sell at 60. Right. I wouldn't sell at 1,000. So as soon as I put my money into Bitcoin or crypto, that's like my not touch money, and that's the bucket that I put it in. Right? That's it's dead to me.
I went to panic sell, but I couldn't log in, so that's that.
Smart.
What's this tweet? What is this?
Smart. Which one?
Why do you have so many enemies? Who?
So Alex Mashinsky was a guy from. He's the Celsius guy, and
what? Wait, what? What do you mean the Celsius guy?
So I don't know if he's the CEO of Celsius, the founder. He's the head of Celsius. And this honestly is pretty.
Let's pause on this.
This is pretty tame compared to some of the other vile shit that was coming
Is his avatar himself as a Roman emperor?
What's wrong with that?
Is this just what goes on these days? One guy is a monkey with a king's crown, and the other guy is a fucking Roman emperor. Honestly, I take this down. I never want to see anything from Twitter again. All right. So what is we don't know what the resolution is of this, but
of Celsius,
Sam Bankman-Fried didn't want to save this one. He wanted to save he wanted to fund the other one.
Right.
I guess he would know better than anyone else, like which players are worthy of making investments in during distress and which aren't.
I also think Celsius had a lot of like detractors that their interest rates were unsustainable from the jump, 18-19%.
Wait, 19% with Fed funds rate at 0 isn't sustainable? I can't imagine.
I feel like BlockFi was maybe more systemic. Like if that went under, that would have been a real bruise for the industry.
Oh, so that's what I was going to ask you. So there's no Fed who's centrally coordinating any of these recaps or rescues or whatever you want to call them, but some of the larger players recognize that it's better for their competitors to stay in bit, or better to
for the ecosystem.
Because the whole thing will go down the tubes, and it'll almost be a self-fulfilling prophecy.
Right.
So that's really interesting that this industry, which is supposedly decentralized, is now coming around to the idea that, hey, maybe there should be some centralization, and we should make sure the system holds. I think that's good. I think it's maturity.
A lot of crypto people are saying that Celsius is not DeFi, that DeFi was functioning fine. Celsius is very much CeFi, TradFi, whatever. Centralized finance.
Why? Because it's very centralized. Okay. I'll never understand that.
It's a bank. It's not a bank, but you know what I mean. All right.
Okay.
Let's talk about the sentiment
washout.
Let's talk about the sentiment washout. So this stat blew my face. Jason Getfer from Sentiment Trader showed that more than 90% of stocks in the S&P 500 fell for 5 of the last 7 days. This was on maybe Friday. That's never happened before. Ever.
Really?
5 times in 7 days. 5 times in 7 days, 90% of stocks in the S&P 500 were down.
That seems pretty extreme.
What you think?
Yeah. I mean, And it's not even like there's a specific reason why. It's not like, oh, there's a war or there's a nuke.
Oh, yeah,
or,
there is.
Like, what? War and inflation?
Well, there is a war.
Fine, but I'm saying it's not like some like 9/11 or something like that. Like it's really strange for there to be like that level of selling pressure that widespread, and nothing like specific is triggering it other than people are just panicking about the economy.
Well, it's all inflation, and I think that investors will cheer bad news. Like the market will stop going down once we start getting some bad economic data. Or not, the pace will slow down.
You think that's where we are at this point?
I think inflation is the only thing that matters.
Okay. So if we start seeing CPIs not till the end of July, we're going to get this M2 money supply thing at the end of June. If we just start seeing like a lessening in that inflationary pressure, it could be enough for stocks to have found their bottom already.
Yes. Now, once we get past inflation eventually, whether it's next month, next quarter, next year, there will be something else behind that we have to worry about. But for right now, it's all inflation, in my opinion. So let's continue with the washout. So I made this chart. The percentage of stocks at a 52-week low is spiking. That usually coincides-ish with the bottom. It's definitely not foolproof because for two reasons. One, you don't know where the top is, right? Obviously, you don't know, like, is this going to go from 39% of stocks at a 52-week low to 50? You don't know where the top is. But even if you did know that this was the actual top, doesn't mean the market can't drift lower, because in 2008, for example, this peaked at 68% in November of 2008. And as everyone knows, the market drifted lower, 25% lower for 5 months to its eventual bottom in March 2009. A few more charts I want to run through. Deutsche Bank had this chart. S&P 500 performance during the first half. We're on track. Obviously, the first half is not quite over, but this would be the worst performance since 1932, which, as you know, was not good.
Wait, S&P 500 performance during the first half in total return terms, the worst since 1932. Does it feel that way?
Feels pretty bad.
It feels pretty bad. So nothing like this has ever happened in my career.
This is bad. It's historic selling.
It's really bad.
It's really bad. All right, another one from Bespoke. We've got the year-over-year change in the S&P 500 trailing 12-month PE. Now, not to be even more gloomy, we haven't seen the E contract yet, and you can't really get a recession without earnings contracting, although I guess maybe crazier things have happened. No, you really can't. So if we see the E start to fall off, forget about it.
Yeah, but wait a minute. Hold this up. If we see the E fall, but we've already done the work on the P, it could be a push. True. Unless earnings collapse. Like if earnings estimates were 15% too high and we have to give some of that back, but the multiple on that has already come down by 25% or so. It doesn't necessarily have to happen twice. We don't need another 25% collapse in the multiple. I feel like the stock market is smart. It's not right all the time, but I think it will see, these are those earnings declines that we've been expecting in the form of our decreasing multiple.
Yeah.
No?
And
is that possible?
If prices stay where they are, you could see the E fall and obviously the PE rise, which is certainly a possibility.
Which would be weird, but it's possible.
And then,
especially in cyclical sectors.
So here's where we at. 0.0.
What the hell is this? What goes into this? Is this Savita?
Put call, probably like a bunch of breath indicators.
Okay, so this is as bearish as it gets?
So if we don't get a recession, then
the kids are saying recession. If we don't get the recession,
then stocks are a screaming buy.
Okay, all right, I'll take it. I like it. I'm not positioned for screaming buy, but
yeah, the S&P is only down 22, but forget about the S&P. Nasdaq's down over 30. Home builders are down 35. You've got blown up stocks all over the place. PayPal's down 78. Shopify's down 80. I mean, everything's blown up, right? Netflix, forget about it. Netflix is back to 2017 levels. I think Disney might be too. So if we don't get a recession, stocks are screaming buy.
I got a comment here. Josh, you got to make Michael realize that money hasn't vanished into thin air. Please, it's embarrassing. And I got excited, like somebody agrees with me.
What the hell?
But then I looked at his name, and it's Bra.
Apple closes at 100, opens at 90. Where does the money go?
Money markets.
Yeah, okay.
The sellers who sold it between 100 and 90 take their capital back, and that capital sits in their brokerage account.
There's not prices at every. What do you if Apple closes one day at 100,
you didn't say anything about gaps.
Opens the next day at 93. Where do you think that money went?
Oh, nowhere, because those are trapped longs. Those are trapped longs. Nobody transacted between those two prices.
It's embarrassing. Next topic.
No, it's not. I'm still right.
Yeah, the market cap disappears and it goes into money market funds. That's how it works.
No, yes, the sellers take their money and they put it somewhere else.
Get the hell out of here. Next topic.
How is this controversial?
Next topic.
How is this controversial? All right, fine. Next topic. What were we doing? Where was I? Did I get lost? Oh, we're going to end with this. It's never a good time to make predictions about the economy or the stock market. Never, ever, ever, ever. There's never a good time. It never works out well. The consensus will always be wrong because surprises and shocks are what drive the market. So this was interesting. This is Bloomberg. Back in December, strategists at the world's top investment firms like JP Morgan Chase predicted the S&P 500 would gain 5% in 2022, which they pretty much always do. Mm-hmm. Economists saw the 10-year Treasury hitting 2% on average by year end. And even Goldman Sachs lent credibility to the claims Bitcoin was on track to hit $100,000. 6 months later, an unprecedented confluence of shocks, it's always unprecedented, has ended one of the most powerful equity bull markets and sent safe haven government bonds and other assets spiraling. The S&P is down 23% instead of plus 5. 10-year rates are now 3.25 instead of 2.
Josh, year's not over.
And Bitcoin's been cut in half or worse. So the consensus has not done well this year. I can't think of many years where they have. It's very rare to have an ordinary or expected year. And this was just one more really great example because of how quickly all of that shit looks ridiculous now in hindsight.
Let me ask you this. Like normally when everyone is on one side of the boat, you want to do the other thing. But I'm thinking about like everyone is extremely bearish. So you would say, okay, so buy. But don't crashes happen when everyone's extremely bearish? You know what's interesting? There's only so many, my opinion, there's only so many contrarians. It's a finite supply. We don't keep making new ones. And they get their asses kicked a few times and they stop being contrarians and they just acquiesce. So we started a little bit of a rally today. Maybe tomorrow we come in, futures are up huge. There's follow through for the first time in weeks, right? Don't forget, 10 out of the last 11 weeks, the market's finished lower than where they started. So maybe now the contrarians get excited. We have a week-long rally, and then a week later, we give it all up. It's hard to once again come in and charge in to buy that dip the next time if this one fails, if this dip buy fails. So I feel like you start out with a finite supply of contrarians. You don't make new ones as you go. And that's unfortunately part of this process of these bear market rallies breaking hearts. And I doubt this time will be any different. So it's tough to say. But I hope this follows through. I don't need it to, but it would be a nice change of pace. I would love some, a little bounce, keep the bears honest. Maybe
100%.
Have people feel a little bit better.
It's gotten too easy to bet against the market right now, and maybe that's a sign. All right, let's bring in Duncan. Viewer topics. What do we got tonight?
Hey guys.
Hey Duncan.
First, before we do this, do you know how many people watch our videos and don't subscribe?
How many?
About 30% of our views.
And what are their names?
People who aren't subscribed. Yeah, I'll give you a list.
Okay.
But yeah, so if you're watching this,
30% of viewers don't click subscribe?
Huh. Yeah, 30%, yeah.
Isn't the better way to say that 70% do?
Sure, but I'm trying to motivate people to subscribe.
What about the other 15%?
Yeah, you see.
Yeah,
it's actually good, but yeah, I want more people to subscribe. So
okay, those 30%, like, what do you think is wrong with them? If you had to guess,
I think maybe they're in like witness protection and they are afraid to like have a paper trail of subscribers.
Let's do it this way. If you have not yet subscribed, we forgive you, but only for one day. Tomorrow we will get mad all over again. Please subscribe to the channel. Okay, what do we got?
Okay, so up first we have a question from our old friend Shrey. And this one is this the time to continue with a DCA strategy or time to move to cash?
Dude, always time to DCA.
I would double your DCA strategy. I would say whatever amount you're putting into the market right now, monthly, whatever you have been doing, find a way to do more unless you're like 80 years old. Because the purchases that you make now, it may take a while for them to look smart, but eventually they will. And you will be so much happier if you did more, not less DCA. And I say that not knowing you, not knowing anything about your situation, but just knowing market history. Anytime the S&P is in a 20% drawdown or worse, you should be finding ways to get more in, not less. Michael, any difference in opinion there?
That's what I did. I've got my monthly DCA into our liftoff program, and I made 2 off-schedule ones also to boot.
Bang! So did Ben, right? Yeah. Didn't Ben do that like a month ago?
I don't know. Maybe he did, but I did.
So you're calling the bottom without really trying to call the bottom, but you just might get lucky at some point by doing that. Quick
plug.
Put
it this way. In 10 years, this will look like the bottom, whether or not the bottom is 20% lower.
That's right. That's liftoffinvest.com. For those of you wondering how you can invest alongside of me and Michael and Ben, we all use our firm's automated asset allocation / financial advisor platform, liftoffinvest.com. Check it out. We have live advisors standing by to help you as you DCA your ass off. All right, what else we got?
Nice. You're making me want to show that liftoff ad.
Okay, but don't.
Okay, so so up next we have a question from Dylan. How does the looming bear market / recession affect the housing market for millennials and Gen Z? And in what ways does it differ from the 2008 crisis?
Michael, take this.
So if you look, 2008 was all about, unfortunately, people that couldn't afford mortgages having housing shoved down their throat. And so if you look at like mortgage originations, credit scores at mortgage originations, in 2008, you see like this really big outlier of people who were subprime borrowers. And I don't say that pejoratively. It's just according to their credit score, they should not have qualified for the size loans that they were being offered. Right now, it's the exact opposite. The people that are buying homes are extremely qualified. There's not a ton of speculation. There's a lot of home price appreciation, similar to back then. But those are pretty much where the comparisons start and stop.
Let me jump in here. I actually have some data. This is from Diana Olick, who covers housing for CNBC. She does a wonderful job. She's been following the housing market for a very long time. She said that the average borrower FICO credit score right now is still at a record high 751.
So that's like
for
perfect
some context, in 2010 it was 699. So it's a much healthier borrower base right now. She also mentions that tappable equity, which is the amount of cash a borrower can take out of their home while still leaving 20% equity on paper, hit a record high 11 trillion collectively this year. That's 34% over the prior year. Now, a lot of that is Fed largesse, of course, but still, that's where we are. Total mortgage debt in the U.S. is less than 43% of current home values. That is the lowest on record. Negative equity is non-existent right now. Compare that to 2011 when 1 in 4 borrowers were already underwater. So this is, again, very different. Only 2.5% of borrowers have 10% equity in their home or less.
And if you look at
98% of the market is in a healthy place on equity.
If you look at debts payments as a percentage of disposable personal income, JP Morgan has this in their guide to the markets. In Q4 2007, right, basically as housing was peaking, that was over 13%. Right now we're just about 9%. So big difference.
Last one on this, ARMs. So adjustable rate mortgage would be the thing that you would worry about when you see interest rates shoot up like this into a hot housing market. But we just don't have as many people who are in these adjustable rate mortgages as we did. In 2007, just before the market crashed, there were 13.1 million adjustable rate mortgages, which was 36% of all mortgages.
Holy shit!
And the underwriting on those loans was a joke as well. Yeah. Right now, ARMs today are not only underwritten to their fully indexed interest rate, but more than 80% of today's adjustable rate originations operate under a fixed rate for the first 7 to 10 years. So in 07, there were 10 million ARMs all facing higher resets. Right now, it's 1.4 million.
So huge differences.
Huge differences. And don't let people scare you. It's not that housing prices can't go lower. It's not at all analogous.
It's not systemic.
It's not systemic. That was a very different environment. So great. Who asked that question?
That was Dylan.
All right. Send Dylan a gift from the Compound Store. For those of you who want to check out the latest in financial blogger apparel, make sure you check out idon'tshop.com, where all of the official Compound merch can be found. Want to remind everybody to like this video if you enjoyed it, got something out of it. Thanks to our live audience for joining the chat. Tomorrow's Wednesday, so you know what that means. All new episode of Animal Spirits with Michael and Ben. And at the end of the week, we hit you guys with a brand new The Compound and Friends.
Who's
and
on
let
this
me tell
week?
you,
Who's on this week?
We're not telling. We're surprise everybody. You don't want to miss this Friday's episode of the Compound and Friends podcast and video. So stay tuned. All right, guys, thanks so much. Have a great night. We love you. We'll see you next week.